HP, ticker HPQ, fell from $39 to $36, so about 8% after reporting their earnings on the 26th of November. Now today they are down by another 11.36% due to their below estimates first quarter profit forecasts on sluggish demand in the PC market. So today we will figure out whether after its huge drop in price, HPQ will be considered undervalued. First of all, we can see that they are a dividend company. They currently have a dividend yield of 3.19% with a trailing free cash flow payout ratio of 27.49%, which I very much like, as it means that the company can direct a lot of their free cash flow into investing back into the business or buying back shares, for example. Now, the one thing that scares me with HP the most is their negative equity value, which is sitting at negative $1.3 billion, which means that their total liabilities exceed their total assets, and to me is a sign of financial distress. Now, jumping to the 9 pillars, we can see that the company has a rating of 8 out of 9. So we can see that apparently the net income has been increasing, the free cash flow has been increasing as well, and the revenue has been dropping slightly. But if we have a look a little closer, we can see that indeed the revenue has been dropping from 56 billion to 53 billion over the past 5 years. Now, if we have a look at the net income, we can see that that actually dropped as well from 2.8 billion in 2019 to 2.7 billion in 2023. And the reason why the growth is positive is because of the huge jump from 2019 to 2020. And that is the same case with the free cash flow. Actually, that has been decreasing as well from 3.7 billion in 2019 to 3.2 billion in 2023. So we can see that the company actually has negative revenue, free cash flow, and net income growth, which again quite scares me. Now, one thing I do love about the company is their very low 5-year PE ratio and their very low price to free cash flow ratio, which means that investors are currently underpaying for every dollar of the company's earnings and free cash flow. The company also has a very decent profit margin. They are buying back shares off of the market very aggressively, as we can see, at a rate of 6.78% yearly, and they have consecutive dividend growth of 9.92% every single year, which is more than double the average. So overall, we can see that the company is doing quite well, but a big red flag for me is their negative growth. So now let's calculate their intrinsic value, first using the Grant's formula revised. And here we plugged in a 5-year earnings growth estimate of 4.68% yearly over the next few years and calculated an intrinsic value of $44.49, which is 22% higher than the current trading price of the company. Now, regarding the second valuation model, we take the free cash flow of the company and calculate a growth rate of 1.8% into the future, and plugging in a discount rate at 8.7%, we get an intrinsic value of $50.46, again quite higher than the current trading price. Now, for the third valuation model, we compare HPQ to its competitors, and after getting the average PE of the competitors and multiplying with the earnings per share of HP, we get an intrinsic value of $55.49. And for the final valuation model, we have a look at the dividends of the company. So we plug in a projected growth rate of 5.33% and get an intrinsic value of $34.95, very close to the current trading price. And now finally jumping to the ultimate valuation, where we average out the 4 valuations and get an intrinsic value of $46.35, which is 33.72% higher than the current trading price of the company. So even though HP's intrinsic value is quite higher than its current trading price, I would personally still not add this company to my portfolio. And this decision is mainly based on the research I did in the back end and based on our 9-pillar analysis, mainly because of the negative growth of the company and its negative equity value. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.